All right. We should be live. We'll get started here right on time in 1 minute. And yep. I finally got it. I got it. I've been working on this and Kyle's not in his seat. Okay. Yep. I think we're live.
Cool. I'm back.
All right. We are live, YouTube and Vimeo. It's taken, I don't know, Kyle, about 2 months for me to figure this out, but I'm working on it for the past 2 days. I think we're good. We have Inside Edge clients in the members area only within my.insideedge.com. We have the public on YouTube, and we're rolling. Man, that was hard.
Making the technology work for us.
We're doing we're doing something
instead of the other way.
Yeah, exactly. Right. That's what we're going to do. We're going to take the first 30 minutes or so, get you caught up on, I'll show you the agenda here in a sec, and then we're going to transition into client-only discussion. We'll talk about that. But Kyle was just telling me his beautiful baby girl let him sleep about 8 hours last night. That's unbelievable.
Yeah. So much energy. I feel like I can accomplish anything.
That was the biggest thing. Like I learned you can conquer the world with 8 hours of sleep with the winds.
Yeah. And I took a lot of 8-hour sleep nights for granted before we had kids, but now I get it.
Dude, it's crazy. And I love my kids dearly, but today was the first day of school for all 3 of them. Bye-bye. We are so productive today. So
a little quieter around the house.
Oh my gosh. Thank God. All right, let's roll. We're going to get started here. A few things. I should be able to see comments, questions, insults. I believe, I don't know if I'm quite there yet. Chat. Just type in something. I believe I can look at any comments or questions. There's a few little features that we'll do along the way. But just type something if you're listening, and I will let you know. But here's screen share. Here's what we're going to cover here today on the Inside Edge live stream. Let's get that full screen there. Okay, so current events recap. End of summer. We're now in September, post Labor Day. There's been some things going on, but I think leading into the market technicals, it's been very tight in August, and I think it's some technicals, meaning like looking at where the market's been on charts is important to give us context to help figure out where we're going. FOMC rate cuts coming up, I think September 17th, and then we'll transition into client only on the Inside Edge side. Kyle, anything else on the open before we get rolling?
Yeah, no. Good presentation put together. I'd say let's get into it.
Yeah, man. All right, sounds good. All right. Okay, perfect. And Nick, I'm watching here. If anything pops up, let me know. Okay. All right, let's go. Looks like everything is working. This is awesome. Okay, so I think the big thing that came out was the Google antitrust. That's CNBC. I'll call you later. And antitrust ruling. Federal court ruled that Google does not have to divest from Chrome, but they can't do any like exclusive only deals for search results. So many viewed that as kind of a slap on the wrist for Google, and you can see the reaction from Google was very sharp. It also gave Apple a bid because I think there's about a 20. Did we have it in here? No, there's I think
$20 billion. Yeah.
Yeah, go ahead.
That's what Apple or what Google pays Apple to preload Chrome and other Google apps onto iPhones.
I think it's specifically Google search as the default search within the iPhone. So Apple's going to continue to get that. So, we'll see. It's still kind of shaken out. They say Google's still going to appeal that, but
Hmm.
It was a nice bump to the growth trade that we're going to talk a lot about. It was a nice bump to the growth trade after a very bumpy opening sort of September market, which we'll talk a lot about, which is more macro. So let's just kind of put that in our back pocket for now. We are coming up on non-farm payroll tomorrow. Kyle, you were looking at ADP today, which was short.
Yeah, just preliminary ADP. The company does publishes their reports on how many new company jobs have been added, and it did come up pretty short in August. The big one is going to be reported tomorrow. That's the non-farm payroll report from the government, and the unemployment rate is projected to increase from 4.2 to 4.3. So that's a slight, I guess, boost to the odds, which we saw that the rates would get cut during the mid-September meeting. So I think not too big of an increase where the recession chance are going to start, but it isn't, an increase is an increase, and that'll put pressure on the Fed to lower rates and maybe some other things to happen on the fiscal side to help the economy.
Yep. I have to think on the headline payrolls number expectation is 75. Anything below 75 could be sort of this dynamic that I've faced in my 2 decades in this business, which bad news is good news in terms of encouraging the Fed to go easier for the stock market, which is very counterintuitive, which,
It
again,
is.
you know, but the unemployment rate going up, does that mean more people are reentering the workforce? And is that ultimately a hawkish or dovish scenario? That we'll leave that for the interpretation. Interrupt me, Kyle, if you have a thought on that one. But
Yeah, that's spot on. It's not always straightforward when unemployment goes up or down, how the market will interpret it. It's obvious, from an economic standpoint, whether it's good or a bad report, but sometimes the market will factor in. I mean, interest rates is huge, so not a lot of new employment that puts downward pressure on rates, and makes the market happy because a lot of companies take on debt, and that makes them able to refinance and their debt or take on new debt at a lower rate and use that money to invest.
yeah, and there's actually a slide coming up. We're going to talk about small caps, which the small cap company, we're seeing a bit of a rotation in the last month into small caps, and that is more interest rate sensitive as opposed to the mega caps, which are not as rate sensitive. But good point there.
Hmm.
Go ahead. You put this one together on expected inflation.
Yeah, just seeing a dip in expected inflation just from last month in August. So we did see expected inflation rates decrease by 0.2%. The expected inflation is lower than the current inflation, and it's decreasing. So, two signs that we are seeing a reduction in the rate, or expecting a reduction in the rate. And also the inflation risk premium, so the amount of compensation that investors want based on the risk of inflation going up, that's basically disappeared. So that is another sign that, if a investor doesn't demand to be compensated for the inflation, that's a signal that the market isn't expecting future increases in inflation anytime in the short term here.
That's interesting. That's interesting. So we're heading into that meeting, which is September 17th. And right now we're almost guaranteed. This particular metric shows 97% chance of Fed cutting. And you're making the point, as we're heading into non-farm payroll tomorrow, coincides with the cooling labor market and inflation slightly. So what tied this point into the prior that you were making?
Yeah, so labor is showing a bit of cooling just here recently. The Fed it has a dual mandate, labor market, full employment, and reasonable inflation. So up until this point in the year, I guess we've had a nice labor market with low unemployment, but higher than expected inflation. If the labor market cools and inflation cools further, then that would be basically two reasons for the Fed to lower interest rates, where before you could argue that they only had one reason to lower interest rates, and that would have been full employment in the market.
Just I think we talked about it last week. We didn't do a presentation over Labor Day, but the signs that inflation expectations decreasing, rates are dropping, which we'll see next. You look at, I didn't include it in this presentation, but like the trajectory of non-farm payroll since like post 2022 is just on a down, a glide lower. And it's like, are companies just not hiring because of the technology efficiencies that are displacing so many jobs? Is that a sign of economic weakness, or is that just increased operating efficiency from companies as they become more profitable, embracing tech and justifying higher multiples? It's tough to decipher.
Yeah. I mean, there's so much discussion around it, and operational efficiency with AI is always brought up as something that'll bring unemployment up, will cause people to lose their jobs. We saw it, I guess, with Meta trimming a lot of their staff here.
Yeah.
I mean, they were, in my view, probably the first company to do it, to really take a hatchet to their workforce, because they could increase their efficiency, and that's one of the common things attributed to the AI, is it's going to make companies able to do this, where before that was all manpower, and now they're able to replace some things with AI. So definitely a threat.
It's a good point, and I don't want to get too far off. I want to keep this on somewhat reasonable time length, but you got to give Meta and Zuckerberg credit. Love him or hate him, like, he's the first one through the wall. And I don't know if you remember when Kramer had that meltdown when he was basically crying because he recommended Meta, but they spent so much on CapEx, capital expenditure, beginning to invest in AI and the hardware for it. He was like, they're such terrible stewards of capital. They were the first one in. And now, I think it's 50 billion is the number, 60 billion is the number they're putting on in terms of building out their infrastructure. It's very high and it's increasing, and the market's giving a pass now. And now they're laying off workers, and they were one of the first to do it because of those efficiencies. So you got to give Meta credit with that, with kind of being first ones through. So, all right.
Yeah, absolutely.
So let's keep going here. So here's the expected trajectory with Fed funds. So like I said, we are 97% chance of cutting 25 basis points on the 17th, which is 2 weeks from now. So this is the current level, 4.25 to 4.5, 97% chance. And then if you look at by end of year, the way I looked at this is, as of now, by year end, there's a 100% chance of 50 basis point cut, right? So it's a 34% chance of being at 3.5 to 3.75, and a 65% chance 3.75 to 4. You add those up, that's 100. So as of now, there's a 100% chance of being at least 50 basis points lower than where we are now. The way that 100% is broken up is it's a 2/3 chance it's only 0.5% lower. It's a 1/3 chance that it's 0.75 basis points lower, if that makes sense. So it's pretty interesting. We're putting in a 100% chance of a cut. And I think this chart does a nice job of displaying that. So what we're looking at here in orange is the effective federal funds rate. That's where the Fed gets together 6-7 times a year. I should know that. And decides where the FOMC policy rate goes. The 2-year Treasury yield, the yield on the 2-year Treasury, is one of the best indicators, or I would say leading indicator, as to where that Fed funds rate goes. So what you want to do is you want to take a spread between where the 2-year yield is suggesting the Fed should set their policy rate. And when that spread gets out of whack, it starts to tell you that the Fed is either, behind the curve or way behind the curve. And being that the spread down here is 0.67%, that means purple, which is the 2-year Treasury yield, is 67 basis points lower than the current policy rate. And if you just look at a simple price floor or support, since 1990, that's about as low as it gets, which means they're out of whack. So the 2-year yield is saying the Fed needs to be, maybe 2/3 of a percentage point lower than where they are. So that's pretty extreme. This is kind of bringing the idea of yields and the impact on the stock market into a shorter term dynamic. We came back from Labor Day weekend and the market was down. I think it was September 2nd. And the S&P will show you that right here. So just a little gap down here in the S&P. And what happened was U.S. yields went up. Okay, yields up, Treasury prices down. And the news from that was federal court declared that Trump's reciprocal tariffs are possibly unconstitutional, which I don't know what your thoughts were, Kyle, when this happened, but you look at the market reaction, the stock market sold off and U.S. yields went up, bonds went down. So the way I look at that is, well, everyone was complaining that, tariffs end of world and it's going to crush the global economy, blah, blah, blah. The stock market didn't like it, but also the bond market didn't like it. And if we had to return those hundreds of billions in tariffs to those countries, I guess the way you would look at that is that would slightly decrease the credit quality of the U.S. is we've got to give that money back. So maybe the bond market likes the tariffs, revenue coming into the U.S. So it makes sense. Stock market also sold off. I think the stock market doesn't like uncertainty, or maybe the way you look at it is you have to give a couple hundred whatever billion in tariffs back. Maybe the stock market doesn't like that. So maybe is that telling us, despite what we hear in the news, the stock and bond market both like tariffs? And again, that's a rhetorical answer, a rhetorical question. Please feel free to give me your input on that.
Yeah, I mean, the tariff uncertainty could create a lot of inefficiencies with the planning that all of these companies have had to do in the past, or I guess 5 months since they really came on. So it's like all these companies making these plans to reshore, and then they find out that there's going to be no barrier potentially to continuing to import. And that just creates so much uncertainty and really bad planning if things don't go the way that everyone was expecting, which is that tariffs would be in place. I don't think this ruling will hold up, personally. There's 3 different trade acts that have been passed that have allowed the president to negotiate trade, including tariffs. Since they've got just pulled up a note that I wrote, the Reciprocal Trade Agreements Act of 1934, the Trade Expansion Act of 1962, the Trade Act of 1974. So that basically was Congress who originally had the tariff responsibility, giving the president the ability to negotiate, including levying tariffs. So again, I don't think it's going to hold up, and I think maybe the market, after the initial reaction, realized that as more commentary, more legal opinion on it came out, that they just kind of brushed it off.
Look at you. Well done, sir. Well done, dude.
Yeah, it's good to know what's going to happen with all these tariffs, or what should happen. And yeah, it remains to be seen, but I do think after the initial, you can see that bounce back there with the S&P that maybe it's not too worried about that becoming permanent.
Exactly. I mean, and you could see that you could see that. So this was Tuesday. No, what is today? Today's Thursday. Tuesday, Wednesday, I can't believe it's Thursday already. Holy cow. You can see that Tuesday, Wednesday, Thursday, we've closed the gap from the drop post Labor Day. And what I find interesting is yields not only faded the sold call gap. They went down. We're breaking this sort of short-term floor at about 4.21, 4.22 that we've seen since June, July, August. So yields are definitely dropping, right? And I think it's just important to take 1 second, just talk about this quickly. We're fundamental, macro, but also technical investors. There's a lot that you can glean from looking at the relationships of the four major asset classes, how they all trade together. And this is like one of the highest level things that I do running the portfolios. You always look at where the equities, fixed income, commodities, currencies, and some would say crypto is also another asset class that, that's up for debate. But, I like to think of ourselves, and Kyle comes from more of a traditional wealth management background, though his dad does a lot of technicals for hedge funds. I like to think of us as visual investors to see how money is flowing and positioning, not only at the macro levels I just mentioned, but, within the sectors in the U.S. in response to the business cycle, and then within each 11 sector, the stocks that are leading those respective sectors. So, I don't want you to think, well, technicals have no place in investing. One, that's wrong. And two, you want to follow the money flow to see how markets are interpreting incoming news, future expected news. Watch how the flows react, and that gives you a lot of hints as to where money and big money is going to be flowing in the future, because trends do exist in the markets. That gives you a really good edge. So I think it's important to be not only a data-based economic and fundamental investor, but also be visual.
Yeah, and bond market, it's so dynamic. I mean, I think inflation expectations going down. You have some countries offloading U.S. Treasuries. I read something about India maybe lightening up on their bond holdings. So just such a dynamic market, and really could be its whole own presentation to try and decipher.
Dude, post pandemic, man, like it's all we talk about is interest rates. I'm so over it. I think everyone is, but that's what's driving, to your point. It's much more liquid than equity markets. It's bigger than equity markets, and it has such a big impact because we had such a long period of low interest rates with no inflation. They weren't that big of a deal. Now it's like the key driver.
Yeah, having to relearn these relationships and rules and just get used to 4+% rates again for years in a row.
Well, as soon as we just said get used to it, I had this chart in the last presentation, but she's wound pretty tight here. 20. So this was the turn in 2022. That's the turn in 23. Here's 24. So we stopped moving up in rates in 24, and man, this thing is getting tight one way or the other. And I can almost guarantee that there will be a noticeable impact in equities based on the outcome of whether we go higher or lower. And I'll just encourage you again, this trend line is important. Connect the lows, and there's technical macro traders out there who say, if we break, if you look over, I think it's probably right around 4%. If you break, what impact does that have on not only equities, but the commodity market and the currency market, right? So, this is the little daily chart that just goes back June, July, and August. You can see it's kind of hanging into that 4.1 area and back to this long-term chart. We're right at about 4.1 right there. So, this goes back to late 24. So there's a pretty big decision coming in yields. Now, there's no real point to this chart because people will say that the macro relationships are not reliable because they change and there's no constant relationship. And this chart is just strictly showing that that's right. So this is the U.S. 10-year Treasury yield. I put a moving average on it. It's a 15-period moving average. The very light gray bars in the background are the actual chart of the 10-year yield. So let's just say this is the 15-period average of U.S. Treasury yields and the S&P. Clearly, there's periods of a very inverse relationship, and then sometimes there's periods of direct relationship. and they are changing, but it's not like they change one day to the next. There's periods of multiple quarters on end where rates and stocks are trading together, which means bond yields and stocks are trading inversely, right? So it's just, you look at when you notice visually, you see a relationship that's sticking out. And I would argue that, just over the last 3 to 4 months, you're seeing yields drift lower as the market is discounting that the Fed is going to cut and the stock market is pushing higher. If anything disrupts that, or there's an idea once we get our first rate cut, do we see, the stock market sell off? I don't know. I don't know. Again, this is a rambling chart as I'm rambling right now, but the relationships come and go, and you have to be okay with that. Okay, so get into the technicals of the market right now. Seasonally, this is the weakest period from 2006 to 25 over the last 20 years. 50% of the time, the S&P is down 0.7% on average. Okay, so it's not a terrible month, and it's not like there's a guaranteed chance we're down. It's 50% over the last 20 years that will be down, and the average is 0.7%. This is the 17-year period prior to 2006, so 1990, 2006. September was tied for the worst month between Sep and July. Okay. Now, what's interesting is the seasonality coming out of September, October, November, December in the 90s into 2006 was ripping into the end of the year. It's not as clear in these last 2 decades. We have, some good seasonal periods coming up in October, November, and December slopes off just a touch. So, we'll see. We're a couple days into September. We're really focusing in on, the relationships between rates and the stock market. Let's look at the technicals of the stock market and start to see if we can identify some levels. So, this is the S&P 500 tracking stock SPY, very traditional chart. I got a 200-day moving average, which you really want to watch the slope of that moving average. And yeah, we dropped below it in the beginning of this year, but V-shaped massively, came right back above. And then I also like to look at, this is dark, I know, but the 50-period moving average. So that's fine. And, a good way to deem whether a market is overbought or oversold, in this case, maybe, inside edge capital included, we think we may be a little overdone. This is a good chart to see how far away from a central average we actually are and say, is my feeling that I think we're overbought, overdone? Am I getting too ahead of myself? And this is the distance in percent terms from the 200-day moving average. And I would look at this very quickly and say, wow, we're really far from this purple moving average. We have to mean revert. Yeah, we are, but we've seen it a lot worse. So this orange line, I think it's probably about 10, 11, 12% above the 200-day moving average, which it looks like it was right there. Over the last year and a half or so, that's about as extreme as it gets. And right now we're at about 8.2. So yeah, we're far away from the 200-day, but not excessive. And we're certainly not far from the 50-day moving average right there. Okay. The next one, this is the NASDAQ 100 QQQ. Same concept. We have distance from the 200-day, which is purple, and distance from the 50-day moving average, which is in blue. So the distance from the 200-day, again, not far. Even from May, June, July of last year, looks like, maybe call it 16, 17% away, and we're only 9. And then we've gotten a lot more extreme. I put this in red, up around 25, 30% away from the 200-day moving average. So we're not overdone as the 200-day moving average, which this is the central mean. This is, a lot of hedge funds and, mutual funds, pensions. A lot of people watch these two moving averages, the 50-day moving average and the 200-day. And again, it's helpful to know how far you are. And we did just go down and test the 50-day moving average in the NASDAQ. And the fact that the histogram is right on 0 means we went down. I know it's really dark, but we went down and tested it. That was on that September 2nd tariff court ruling that it was unconstitutional. Market sold off, went down to the 50-day. Those of you who know me from the Elliott Wave world, real quick, maybe 1, 2, 3. August has been a series of lower highs, higher lows, consolidation. I think gun to head, we break higher. Okay. So, again, we'll see what rates do and the impact that they may have, if any, on the stock market. But technically speaking, the takeaways are: one, we're not overdone in terms of excessively overbought relative to the moving averages. Two, there's precedent using the wave theory that this is a triangle consolidation, which usually resumes in the direction that was in place prior, which is higher. If I'm wrong, we know where we're wrong. We know where trendline support is. We know that these two pair of highs from late 24, early 25 are going to be kind of the pivot in the market. So if we were to start to break down, this is going to be the next decision level. And Kyle and I, I'm going to put you on the spot a little bit. Like, you and I said, we're about due to rebalance the portfolios. And you said, we've had a good year. Do we want to take a little bit of heat off, a little bit of pressure off, and maybe raise a little bit of cash in weaker positions? Or, if I maybe made the case to you that we're not significantly overbought, it just feels like it. Do you still feel that way? Do you, based on everything you said, like what's your gut?
Mathematically, I think it makes sense to stay in. We got through April. We don't see any systemic, like, overhanging risk on the horizon that we can point to and say, like, this is worth avoiding. But I think from a volatility standpoint, I think that's the argument you would make to maybe take some off for a short period, take some profits in something that's well above our price target that we think would be good to just hold in cash just through seasonal weakness. So from the mathematical, like, historical angle, I think you stay in. But on the kind of the behavioral, financial, what do you do when things are really good? Well, sell high and buy low, right? So, and then
It's a lot easier said than done.
Oh yeah, totally. And I mean, as a long-term investor, like, putting that at the forefront of your decision making, like the current market or the current outlook driven decision making process, it usually fails, honestly, because it's so hard to predict.
Yep.
You have to predict when to get out. You have to predict when to get back in. No one knows.
Let's
exactly
complain.
How it's going to go.
Let's complain for a minute, like no one else is listening right now. But we also have to manage the expectations and risk tolerances of our individual clients who everybody is not the same, which is great. I mean, that's why we want to run a small boutique investment shop. We have to manage the personalities and goals and tolerances of individual clients, which that's why we're professionals,
Yeah. And our system of, I said, like, it's not great to be market focused and just current outlook driven, entirely bouncing in and out.
Yes.
Most people fail at that. The way we do it is goal driven and planning focused approach, where we know what your capital needs are to hit your goals, and then we manage the volatility in a way where if we hit that historical kind of that balance, and then we also know what you're comfortable with, you put that together and you have a good long-term strategy where, April or whether it's April or 2022 or any of these other bear markets that were temporary, that we're with your volatility constraints. It's not going to be whipping around as, we're going to limit it to the degree that we can every time. And we have that return objective in mind too. And then, once you have those in place, you can really just be locked in and
well said,
getting where you want to be.
All right, enough sales pitch. Well said. That's really well said. So it's managing based on goal. I have to go back and we're going to clip that part, and I want to post that out on socials. That was really good. It's goals based planning in each individual client circumstance, but then what we also do is come up with different objectives and risk tolerances and return expectations for our different portfolios based on clients' micro circumstances and our macro portfolio characteristics. The two come together. So that's
absolutely.
That's a good point.
And And if we only traded during corrections, I mean, we have a number of clients and people come in at different times, but there would be so many people that would have just been sitting on the sideline all through 2023 and through, all of 20 or most of 2024. And it's just like, you can't be just current outlook driven on that regard. Like
Well said.
you get left behind, and that's what so
All
many
right.
people
You
are
ham-
dealing with right now.
You hammered that
Hammer.
point. Well done.
Yeah.
Well done. All right, let's keep moving.
Had to.
Well done. that was good. Well said. All right, so real quick on this one, I just want to address it. Small caps, yeah, and Kyle said it earlier. Small caps are more highly correlated, more positively correlated to the direction of rates because small cap businesses don't have huge balance sheets where they can go issue debt, and the rate they pay on their debt in the debt market is on par with the quality of the balance sheet and income statement, right? But small caps who don't have that have to go to local banks and regional banks, whatever, and they're going to pay the prevailing rate to finance any debt. So as rates have been moving down, which we argued earlier, we didn't argue, we brought up the idea that, okay, why is inflation and rates going down? Are the markets starting to tell us that weakness is coming? You're seeing a boost in small caps because they have access to lower funding rates. So here's IWM, Russell 2000, starting to make a move up, has not yet taken out the late 24 high, which clearly the NASDAQ and the S&P have. And this is just a very quick way to look at the relative comparison of small caps, which is IWM, to the S&P 500 large cap. And you can see, to say you want to diversify in small caps is, sorry, but just ignorant. I mean, if you look at the underperformance, just look at the ratio of IWM to S&P over multiple decades. It's been lower. So yeah, we're starting to see a glimpse of small caps outperforming S&P. And if I were to overlay yields in this, they would be correlated. So yeah, we've seen a little bit of a boost up in small caps, but we still have a lot of overhead wood to chop, a lot more to prove on small caps being above this level and the IWM S&P ratio turning up. All right, let's talk about growth value. I'm going to get moving on this real quick. Last time we got together 2 weeks ago, I mentioned, I wish I kept the slide in there, that value was starting to move ahead of growth. That was a short-term hiccup, and it's now starting to unwind. So Vanguard Value, I gave you the top 10 holdings in the Vanguard Value ETF, which is VTV, and the Growth ETF, which is VUG. Those are the top 10 holdings. NVIDIA's 12%, Microsoft's 12%, so on and so forth. You're starting to see a little bit of a hook up in the Growth ETF, okay, and a hook down in value. That is going to correspond to the NASDAQ pulling back ahead of the S&P and certainly the Russell and also the Dow. So this is the two sort of divided into each other, growth value ratio. As this ratio is moving up, growth is outperforming value, or value underperforming growth. And there's a little bit of a technical pattern called three drives to a high. It kind of looks like this, and it sometimes would signal a reversal. But just in here, if you can really see, we're starting to head back up, and it's very short term. It's not even viewable on the screen, but it's starting to head back up. Again, back to the last slide, which is why you're getting a little bit of a hookup in growth and down in value. So as we're coming to that end of the technical consolidation in the markets, we're starting to see that. I'm just going to do this one quick. The relative rotation, we covered this last week. Growth on the monthly over the last 2 years has been losing some momentum, but still on the right side of this chart, which means growth is clearly outperforming value. And if you look at the 2-year performance of Vanguard Growth, it's up 57%. Vanguard Value in that same time is up 33%, and the S&P is at 41%. So being that growth is on the right, value is on the left, you can see that growth is clearly outperforming. Now, if we were to do a full switch, and this trades like a clock on the wall, mostly in a clockwise fashion, if growth were to be on this side, value were to be on this side, you would see these returns very much switch. Okay. So what we're looking for here, this is the weekly. Each one of these dots represents, 5 trading days. Each one of these dots represents, 22, a monthly, 22 days, which is monthly. We want to watch these relative rotations, and we'll keep you posted. If you start to see VUG start to do a hook back up this way, that's on the weekly. That's going to encourage VUG growth to do this hook and maybe even get back in the leading quadrant, which that is going to certainly foretell significant outperformance of growth relative to value. And doesn't matter where you are in lifespan, you want to have active managers who can tilt you more towards growth while growth is clearly in the lead, because those are the returns you need to put down for when the rainy day comes, quarters, years, decades down the road. But this is something I'm going to be closely watching. You don't really need to understand this if you want to. I'm happy to give you more information. But if we can just get the rotation back up in growth, it's party on. I'm going to skip this one. We went a little longer, but this is the actual sector rotation. I even made a little video for you. We'll come back and hit this one next week, I think. We're running a little long. But what this is showing, what this is showing is, come here. And you can hear I was listening to some music in the background. Why won't it stop? That's all right. I'm blowing this last slide. So what we're looking at here, I'll find a better way to present this, but these are the major sectors as well as the Russell, the S&P, and the NASDAQ. I just sorted these by percent change quarter end. We have one more month left in Q3, which is interesting because the small cap Russell is actually leading this quarter, up 8.45%. The S&P is at 4.3. The NASDAQ's at 3.4. Okay, great. Then if we kind of look on down, it's utilities, materials, financials, tech. So this quarter has been not a very tech or growth led quarter, and we can see that because just we saw value outperforming over the last month or two relative to growth. But if we look at year to date, okay, so this is going to be about 9 months. Communications are up 70%. That's Meta, that's Google, that's Spotify, that's T-Mobile. Industrials behind it, technology. Here's the NASDAQ. Utilities, which are acting like a growth trade. So just kind of showing you where we've been quarter to date, year to date. And the big thing that we're seeing on the rotations, the big takeaway is technology is trying to do the hook up. It sort of went out of favor as the value trade came over the last month or two. If tech can reemerge on a clockwise fashion and get back in, that would be good. Communications are just hanging out here to the right. Communications are the leader, and that's why you're seeing comms up 17%. Again, that's Google, Meta, Spotify, and so on and so forth. So, I think the big thing is maybe a lot of the gains have been seen in communications already. Are we going to see this move back in technology, which is going to include semiconductors? And based on where the broader market is going, these are questions we're going to have to answer as we get ready to rebalance, reallocate the portfolios. Okay, so we're going to leave it there on the public side. Kyle, comments, questions, anything before we head over to the members area?
No, I thought that was great. Thanks everyone on the public side for tuning in, and we'll see you next week.
Sounds good. All right, we're going to turn off YouTube, and if I actually pull this off, Kyle, this is going to be amazing.
Fingers crossed.